Good afternoon. Good afternoon. It's Monday, the 11th of May. Welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. And are we back to square one? We've got Trump and Iran rejecting each other's peace proposals. We've got oil trading higher. But there's something interesting happening in the Singapore market, though. Despite all this macro uncertainty, on a fundamental level, the outlooks from a lot of the Singapore corporates that are reporting their first quarter results are actually still pretty positive, especially going into the second half of this year as well as going into 2027. And that's what management teams are saying. So there's quite a bit of high expectations in the market. So that's what we're going to be focusing on today's show. High expectations around some of these Singapore corporates. So we're going to talk about all this with Jarek Seed, who's going to be speaking about the Singapore tech sector and why expectations are improving here. I will talk about Singapore banks and particularly about OCBC and why we have upgraded this stock to a buy today. And then we got Zonhao coming in to talk about expectations from some of our recent joiners from a corporate for a corporate day. These include AEM, Everglory, and Tiangun. And plus, we've got some fresh charts from our chart guy as well. So quite a lot to go through in our show today. Let's start with Jarek. Now, Jarek, you bumped up Frencken's target price by about 30%, while warning that the first half will still be slow. Now, the stock's already up around 68% in the past 3 months alone. Why should investors still buy this stock?
Sure. Okay. I think even though Frencken is likely going to have a weaker first half, if you look at it, I think they are still bullish for a better full year. That means that we are expecting actually a strong second half. I think first half we are expecting weaker because last year it started with a high base. ASML orders were very strong last year, and I think they have some existing inventory that they have to clear. So first half for Frencken will likely be impacted by ASML weaker orders. But in second half, we expect both AMAT and ASML to ramp up again, which will then contribute to a much stronger second half than last year's second half year on year. So we do expect second half to be strong and will make up for the weaker orders in the first half. So year on year, we still expect orders to be stronger and revenue to be stronger. Next, if you compare that Franklin's valuations as compared to AEM and UMS, basically they are still the cheapest among the three. So I think that's why we are still putting a buy with a higher target price, even though we are still expecting a weaker first half. But net valuations are still lowest among the three.
That's good. That's good. So basically, if there are some disappointments in the first half, that actually might be a good opportunity to get into the stock.
Yep.
Okay. Let's go to Venture. Now, their first quarter results are already out, and you actually upgraded the target price there by about 18%. What's the driver to buy Venture right now?
Sure. I think Venture has sort of bottomed as of 4Q last year. And I think that, going forward, there's a few MPIs that Venture has been embedding themselves into and chasing in the AI equipment space. And I think they're likely going to gain some traction in the second half of this year. So we do expect, Q on Q, starting from 1Q announced earlier, to be stronger Q on Q. And we do expect all these MPIs to come through, in the AI data center space. They're also seeing some traction on the semicon space. Next, they're also seeing traction with their consumer lifestyle, which we suspect to be the IQOS. We think that IQOS is likely going to launch a new model in 3Q this year, which will likely be launched in Japan. And because the last few IQOS has always been launched in Japan. So we do think that volumes will also pick up for that segment. So all in all, we do expect Venture to have a better year this year. Last year should be bottoming, and this year should likely see orders increase and also profitably increase. And if you look at valuations wise, the tech sector in Singapore valuations have gone much higher, and Venture now seems to be the laggard, as compared to the other semicon names. And if you look at also the dividend yield, Venture is having a close to about a 4+% yield. And also they have a very strong net cash balance sheet, which they can actually do more share buyback and more dividends if needed. So that's why we upgraded venture to a buy with a higher target price.
Yeah, I mean, do they kind of fall under the same sort of cycle as the other semiconductor players, or are they in a slightly different product cycle?
I think they are in a more slightly different product cycle. I think semicon revenue has gone from a low single digit to now maybe a high single digit revenue for venture. But bear in mind that venture's revenue is close to 2.6 billion a year. So they are completely different from the other semicon players. I would say that they are more slower in terms of growth and revenue growth because they are too big. And they are not very focused on semicon, which is why the other three players are more focused on semicon in terms of a percentage to revenue. So
Hmm.
they are of a different cycle, but that's why we cannot price them the same PE as what we are pricing for the other three players. So we're actually pricing venture at a much lower PE as compared to the other three.
Understand. Okay. And then finally, there's been some very, very strong momentum in Addvalue Technologies. Your target price alone has 121% upside. What do you think is going to catalyze this stock forward?
Sure. I think next upcoming earnings, the year-end earnings in end of May should be a positive catalyst. I do expect them to do well, in line or above my estimates. We do expect earnings to double almost every year, starting from this with upcoming results. And we do think that, with the current traction of orders coming in, we do expect, these revenues and our targets to be met quite easily. Addvalue is also undergoing expansion in their office. Addvalue almost went bust, 2, 3 years ago, before this tailwind of the sector came in. So for them to currently undergo expansion, I think it's quite a huge vote of confidence into the future orders that's supposed to come. And I do think that will reflect in our numbers or maybe even better than our numbers. So also the next thing is also the US listing. If you look at stocks, all the space drone related stocks in the US, even like Rocket Lab, one of their customers just announced a good 1Q and stock is up 30%. Previously we did a peer comparison and the peers are trading at about 60 to 70 times price to sales. And Rocket Lab with that still can go up 30% on last Friday. So we do think that space valuations or drone valuations plays are still doing fairly well in the US with much higher valuations. So if Addvalue were to list in the US, we do expect, Addvalue to have some positive momentum as well. And next is also on the SpaceX listing, which is targeted to be June, July. We do think that listing also will be a positive catalyst in terms of sentiment and valuation across all the space and drone stocks, which Addvalue will likely benefit from.
So thematic play there. And actually, Addvalue presented during our corporate day last week. The management was there, and they were pretty upbeat as well. But we'll get into that a little bit later on. Now, thanks, Derek. Now let's talk about banks after the first quarter. We are upgrading, as I said, OCBC to a buy with a target price of 24.45 as the management's next frontier strategy and cross-platform execution begin translating into earnings upgrade risk. So I think OCBC has a highest risk for earnings upgrades going into the rest of the year. But let me take a step back before I talk about OCBC and I want to focus a little bit more on the three broad trends that we saw after the first quarter results. First, despite the US-Iran uncertainty, at a fundamental level, expectations are intact, or even I would say expectations are quite high for the sector. While there are some cautious sounds from management in terms of the macro, none of the banks have actually pulled back on the guidance that they set during the fourth quarter. So that was before the whole US-Iran conflict. And asset quality is actually holding up a lot better than what we expected. Second, we are seeing clear shifts in strategy towards non-interest income, not just in the wealth continuum, which is growing very, very strongly, especially for DBS and OCBC, but also there's a stronger concentration on capital market fees, transaction banking, loan fees, etc. And trading income is also likely to be elevated than in the previous years. And part of that, or quite a significant amount of that, is being driven by client flows instead of just, own trading activity. So that's something that's good, and that actually helps with better earnings visibility overall for the banking sector. Third, there is more articulation on how AI is being deployed across their platforms, with more emphasis being on efficiency gains rather than cost cuts in delivering their cost to income targets. All three banks are guiding for below mid 40s cost to income ratios, and in general for about a 20% boost in terms of productivity through AI. So that's quite a big boost as we go into the next few years. Now, as I specifically going back to OCBC, first quarter earnings were ahead of expectations. Most of that was driven by a sharp acceleration in non-interest income. Wealth management income surged about 43%. 34% year on year, with insurance and trading income both delivering double-digit growth as well, reinforcing that OCBC's one OCBC model is actually working. The key story here is the quality of the earnings mix. Trading income now is overwhelmingly customer flow driven, around 95% of it versus around 45% for the rest of the banks, highlighting a deepening integration between trading and their wealth franchise, while Great Eastern is pivoting more towards high margin insurance products that should support better earnings visibility and recurring earnings going into the next few quarters. Net interest income remains under pressure. It's down about 5% year on year. NIMs are down, but management is driving loan growth pretty aggressively. Particularly in Singapore, we saw loan growth in Singapore for OCBC expanding around 12% versus the system was around 6.5%. So shows a deliberate drive towards gaining market share. And we are upgrading our non-interest income earned by some pretty big numbers, around 11 to 16% for the next 3 years, because we are getting a lot more confident on how they're executing their across that platform strategy across wealth, trading, as well as insurance as well. And also, strategically, we are seeing OCBC moving deeper into the region, into ASEAN and Greater China integration. They got about $5 billion of new wealth money coming in from Hong Kong alone, total, and a large part of that was coming from Hong Kong. And that again shows how well they're integrated with their twin hub strategy of Hong Kong and Singapore. Plus the acquisition of HSBC Indonesia, a wealth business. Now that's also an early signal showing that they're executing their next frontier strategy for growing closer in ASEAN a lot better as well. Plus, we think that there'll be a lot more capital management coming in. Only about 23% of their 1 billion share buybacks have been done. We think the rest of that will actually come back as a special dividend, so that'll actually increase the yield for OCBC. CET1 ratio is very strong, about 17%. So there is potential for a higher dividend payout ratios than what management is guiding. So basically, we have a bank that has a high potential for more yield and also generating earnings growth as well. So that's why we are calling OCBC a buy. So in terms of our preference, we have OCBC as number one preference, followed by DBS, and then UOB. Now, with that, let's turn to Zuan Hao to talk about Maybank's recent corporate day. Zuan Hao, we had 4 companies presenting during our corporate day. This was mostly for institutional investors. We had senior managements from all these 4 companies presenting. So we had AEM, Addvalue Tech, as well as Tiang Moon and Everglory. Now, I'm going to skip Addvalue Tech because we already got quite a bit of color from Jarek on that. But let's talk about AEM. What were some of the key highlights of AEM, particularly given the sort of very strong performance of the Singapore semiconductor sector?
Yeah, so thanks for having me, Dylan. So for AEM, management has highlighted that they should be the key beneficiary of this ongoing global AI demand. with AI demand and high-performing HPC chips rising in complexity as a result of this demand, they actually believe that this should structurally increase semiconductor test intensity. So with more complex chips, this actually requires a longer test time per unit. So we believe actually this should boost demand for AEM's cost-efficient test solutions. So as a result, management was guiding 15 to 28% revenue growth just for FY26 alone. So this should be underpinned by its AI and HPC chips momentum. And this is actually meant for a multi-year demand ramp up rather than a cyclical uptick. So most attention will be paying more attention onto that. The next highlight as well was their recent strategic partnership with ASE Technology. So as ASE Technology, they are specialized in outsourced test solutions. So that is I think ASE is quite a big name in the industry. So combining AEM's proprietary test solutions with ASE's global manufacturing scale, they believe this should accelerate their AI and HPC test innovation, which should expand commercial reach and potentially enhance long-term capital growth in the coming years. So I think all this should point towards AEM's turnaround profitability and growth story in the next few years to come, should AI demand sustain.
Got it. Now let's turn to the construction players. What were some of the key takeaways from Everglory?
So Everglory is a bit more interesting. Everglory's construction play is that its near-term catalyst would be Changi Airport's Terminal 5 tender. So management believes that this should at least provide a 2 billion increase to order book if awarded. And this will be an 8-year build-out, which would support long-term revenue visibility. So this actually plays into their competitive edge, given that they are one of the only M&E players in Singapore with a full scope capability. So they have the highest BCA license grade, which is at L6. And at the same time, through their acquisition of Guthrie Engineering not too long ago, they are one of the M&E contractors with airport specializations needed to execute this T5 project. So this should provide them a major earnings and pipeline uplift. At the same time, they did reiterate that, there were 5 main contractors tendering for this T5 project, but they have been in contact with all 5 tenders. So actually, we believe that no matter who wins the tender, Everglory is most likely to benefit from it as a subcontractor of these M&E works. So this should be the key takeaway for Everglory in terms of this Singapore construction boom.
Got it. And then very quickly on Tiang Hoon, what were some of the key takeaways for Tiang Hoon?
I think similarly, Tiong Woon is also benefiting from this construction boom. So as with the Changi Airport T5, LTA works and ongoing semicon facility construction, they should have a robust demand backdrop as well. But the more interesting part would be that Tiong Woon is actually also a beneficiary of AI demand. So with the AI fieldwork data center build up ramping up across ASEAN, they are also getting contracts for crane management, crane lifting works as well to build all these semiconductor facilities. So I think this is also one pillar at play here for Tiong Woon. So they believe with AI center demand and Singapore ongoing construction boom, they should be a key beneficiary from all these structural tailwinds as well. Yeah.
Got it. That's quite interesting. They're the crossroads of data centers, AI, and construction as well. I mean, as a reminder to our viewers, Singapore is undergoing a construction boom. There's about $100 billion of projects that are being rolled out between now and 2040. So there's quite a long, sustained growth for construction here in Singapore, and quite a few players will benefit from that. Now, let's go to our chart guy. We've got a couple of trading ideas today. We've got HUATIONG Global with a trading buy call. They've rebounded strongly from their 23.6 Fibonacci retracement level, setting themselves up for a good uptrend from here. So have a do look at the chart on our newsletter today. Then we also have Q&M Dental with another trading buy as well. The stock is currently undergoing a correction phase within a newly formed downtrend channel, but the recent advances could be an early indication of a breakout. So do have a look at that chart for QNM as well. And fundamentally as well, QNM is growing quite strongly, particularly outside of Singapore as well. With that, let's have a look at some upcoming events. We are now in the tail end of results season. China Aviation Oil out on the 11th of May. We've got quite a few other stocks also out today and tomorrow. Well, today mostly. Multichem as well as United Overseas Insurance. With that, we are out of time. Thank you so much for your attention today. We will see you next week. Have a profitable trading week.